Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall, and here with me today is John Chatfield-Roberts, manager of the Jupiter Merlin Growth Fund. Hello, John.
Emma, nice to see you.
So, of course, you run a suite of Merlin funds, which are appropriate for different investors depending on their risk appetite. But today I wanted to focus on the Growth Fund. And one interesting element that I found is I think a number of investors, when they think growth, they think emerging markets. But this fund in particular has a larger proportion in developed markets. Why is that?
Well, I think it's erroneous to think that stock market growth and economic growth go hand in hand. There isn't a one-to-one correlation. And yes, emerging markets economically tend to grow faster than developed markets, but that doesn't mean to say that you're going to make more money out of emerging markets. For instance, Latin America this year, one of the funds that we own has lost 14%, and that's in a year when most developed markets have made you pretty much double-digit returns.
I think perhaps people would say that developed markets have done so well since the credit crisis, of course, that is there more to have? Particularly, I know you've got a large allocation to the US. Has that got more to run?
Well, it's interesting that the US does look quite expensive on a number of measures, including the 10-year Shiller PE ratio. We do think it is an economy that has the sort of entrepreneurial spirit. People are there to make money, and the managers that we've got in our portfolios are value investors by and large, so we're looking for people who are actually looking at the downside as well as the upside, and we've made good money out of them. So
this isn't necessarily the same sort of US exposure that you may have had 5 years ago?
That would actually be probably an erroneous answer if I said it's completely different. There are some differences, but we have actually moved away from a couple of growth-type managers. It's all about buying people, really. But your point about the valuation is well made.
And is it perhaps also a case of not just that you do continue to see fantastic opportunities in the US and in developed markets, but also, as you hinted with that Latin America fund, there's a lot of negative macro backdrop to investing in emerging markets at the moment. China looks very uncertain, Russia looks very uncertain. You know, of the BRICS, perhaps only India is continuing to offer, stock market growth.
Well, it's interesting you say that, because if you look at China from the economics side of life, yes, it's been growing more slowly, and they've been very clear that the government is trying to reduce the overbuilding property, that sort of thing. But it also looks like they're trying to put, if you like, a rocket under the stock market. There's talk of equitizing their debt. So very recently, the Chinese stock market has been really going up very fast. If you look at the number of brokerage accounts that have been opened in China, it sort of makes one a bit nervous, really.
Too many people flocking to the market? Well,
it looks more like a casino and less like serious investors. But in this world, you have to take risk on board to make returns.
But that doesn't change your stance, does it? Because your stance is a longer-term one. Speculation isn't really what the Merlin suite of funds is about.
Well, what we're trying to do is make money for our investors over and above the rate of growth of prices and that sort of thing over the long term. We've been running the Merlin funds at Jupiter since 2001, and in fact we were running them earlier under a different guise at Lazard from 1997. And actually, we've done it okay over that time period. But it is, the race has never finished. There's always tomorrow, and you shouldn't rest on your laurels. But actually trying to go for the next big thing can be a mistake. You want to compound on a gentle basis.
John, thank you very much.
Thank you, Emma.
This is Emma Wall from Morningstar. Thank you for watching.